Stand in Toronto in 2025 and the numbers tell you Canada is wealthy. Household net worth sits at record highs. Banks report steady profits. Glass towers climb upward. Cranes sweep across skylines. Immigration flows run at historic volumes. By every surface metric, GDP growth, employment figures, asset valuations, the country looks prosperous. Yet wages feel tight. Services feel thinner. Younger households behave as if the future has already been rationed. The common explanation is simple. Canada is expensive because demand is strong. Housing costs reflect desirability. Debt is high because people can afford it. If things feel harder, it's inflation, bad luck, or temporary mismanagement. That explanation feels reasonable because the balance sheets say it should be true. Canadians have never been wealthier on paper. Pension funds are enormous. Government debt looks manageable compared to peers. The system appears stable because the numbers say stability exists. Strip housing out of that calculation and the picture collapses. Productivity growth is weak. Business investment per worker lags every comparable economy. Real disposable income growth has flatlined for years. Canada looks rich because assets are expensive, not because the economy produces much. The damage is not looming. It is already embedded in how the system measures success. For decades, Canada's economic model was never designed to be spectacular. It was designed to be stable. The country specialized in capital-light growth, natural resources, trade access to the United States, a skilled but moderate-wage workforce, conservative banking, and a social safety net that smoothed shocks without crushing incentives. Housing was a consumption good first and a store of value second. Credit existed, but it was rationed carefully. Immigration expanded the labor force roughly in line with infrastructure and capital formation. This worked. Growth did not depend on speculative booms. Banks earned steady returns by financing businesses and households without extreme leverage. Governments could fund services because productivity gains expanded the tax base. Middle-class wealth accumulation came from income, pensions, and long-time horizons, not from timing markets or extracting equity. The system distributed risk forward. Growth today paid for capacity tomorrow. Roads, schools, power grids, and firms were built ahead of need. Housing tracked incomes closely enough that shelter did not dominate economic decision-making. Households saved, firms invested, governments planned. This was not an especially dynamic system, but it was coherent. Canada was not rich because assets exploded upward. It was comfortable because the economy converted labor and capital into output with relatively little distortion. That coherence is what quietly broke. The first shift was subtle. Asset inflation replaced productivity as the primary growth signal. As global interest rates fell and financialization intensified, housing became the safest, easiest place for capital to go. Returns looked steady. Volatility looked low. Policymakers did not create this intentionally. They simply stopped resisting it. Households responded rationally. If wages lag assets, borrow against assets. Home equity became the substitute for income growth. Consumption stayed high not because productivity improved, but because balance sheets expanded. The economy learned to mistake leverage for prosperity. In a basement apartment in Hamilton, a couple with dual incomes and no children realized in 2019 that their combined salaries would never close the gap to ownership in their city. They moved their search outward, first to suburbs, then to exurbs, then to towns they had never heard of. The math was simple. Monthly rent absorbed 40% of take-home pay, but a mortgage on a distant property would cost the same while building equity. They bought a townhouse 90 minutes from work. Their commute became 4 hours daily. Their savings rate dropped to zero. On paper, they became wealthier. In reality, they traded time and liquidity for an asset whose value depended entirely on someone else being willing to stretch further. Banks adapted next. Mortgage lending is capital efficient, politically protected, and socially normalized. Compared to financing businesses, risky, cyclical, labor-intensive, housing credit was clean. Balance sheets tilted, credit creation increasingly flowed into existing assets rather than new productive capacity. Canadian banks now hold mortgage portfolios that represent over 70% of total lending. Business credit growth has trailed population growth for a decade. Firms followed incentives too. Why invest heavily in productivity-enhancing equipment, research, or scale when returns are uncertain and labor is expensive, while real estate appreciation offers passive gains? Capital formation slowed. Canada's business investment per worker drifted downward relative to peers, even as population growth accelerated. The country added millions of workers without adding the tools, systems, or infrastructure to make them more productive. Governments, facing aging demographics and voter sensitivity, leaned into the same mechanism. Rising land values inflated property tax bases without explicit tax hikes. Immigration increased demand faster than supply could adjust, keeping asset prices elevated. Public services strained, but asset-driven growth masked the erosion. Growth targets were met on paper. Demographics amplified everything. Older households, already asset-rich, benefited from rising prices and low volatility. Younger households were forced into higher leverage or permanent rentership. The political economy tilted toward protecting asset values because too many institutions depended on them. Pensions, municipal budgets, household retirement plans, bank solvency. The feedback loop hardened. High prices justified more credit. More credit justified higher prices. Any attempt to slow housing risked collapsing household balance sheets, bank stability, and public finances simultaneously. Asset substitution was not a side effect anymore. It became the operating system. Canada did not become poor all at once. It became expensive instead of productive, and the difference was postponed through debt. By this stage, the outcomes look accidental only if viewed in isolation. Look system-wide, and the pattern is obvious. Productivity stagnates, but GDP grows via population and price effects. Real wages stall, but consumption persists through borrowing. Public services deteriorate, but fiscal metrics appear stable because asset inflation fills the gap. A municipal council meeting in a mid-sized Ontario city in late 2023 debated a proposed zoning amendment to allow mid-rise residential construction near a transit corridor. The room filled with homeowners. None opposed density in principle. All opposed it near their property. The amendment died quietly. The mayor, facing re-election, did not push. The land remained zoned for single-family homes. Prices in that neighborhood rose another 8% the following year. The region's per capita GDP growth was negative. Every attempted fix reinforces the problem. Tightening housing supply without addressing capital incentives worsens affordability. Expanding credit access helps buyers briefly, then locks in higher prices. Boosting immigration without parallel capital investment strains infrastructure and suppresses per capita growth. Protecting banks protects the asset loop. Institutions behave exactly as designed. Banks avoid risk. Governments avoid visible pain. Households optimize for survival within the system they are given. No single actor is malicious, but the collective outcome is extractive. This is where historical comparison becomes clarifying. Japan in the 1990s did not collapse. It ossified. Asset values dominated economic thinking. Growth became defensive. Institutions aligned around preserving balance sheets rather than generating output. The country remained stable, orderly, and wealthy in aggregate, but individual living standards stagnated for decades. Canada differs in scale and demographics, but the mechanism rhymes. Stability is purchased by sacrificing dynamism, and the bill is paid through time. One number reframes the illusion. Canada's real GDP per capita has grown roughly 4% over the past decade. The United States, over the same period, grew nearly 15%. That gap is not cosmetic. It is the difference between producing wealth and repricing it. Canadian household debt now exceeds 180% of disposable income, the highest in the G7. That debt did not fund new businesses, infrastructure, or productivity tools. It funded the transfer of existing assets at higher prices. The system is not broken. It completed its transition. At this point, escape options narrow dramatically. Policymakers cannot deflate housing without detonating balance sheets. They cannot inflate wages without triggering price pressures or capital flight. They cannot meaningfully cut services without political backlash, nor expand them without higher debt or taxes on a shrinking productive base. Voters are trapped too. Older households defend asset values. Younger households need prices to stop rising but cannot tolerate collapse if they are already leveraged. Renters subsidize owners indirectly through inflated costs and strained services, but lack political weight. Everyone senses decline, but each group fears being the one forced to absorb the loss. A new graduate in Vancouver with a degree in engineering accepted a job offer in Seattle in 2024. The salary was 40% higher. The rent was comparable, the tax burden was lower, the commute was shorter. When asked why he left, he did not mention opportunity or ambition. He said the math did not work in Canada. He was not angry. He was not political. He simply ran the numbers and left. 12 of his classmates did the same within 6 months. Capital is trapped in plain sight. Pension funds, insurers, banks, and municipalities are all aligned around preserving asset stability. Productive reinvestment looks risky compared to protecting what already exists. Canada's largest pension funds now hold enormous real estate portfolios. Their returns depend on valuations staying high. Their mandates require them to avoid risk. Their incentives guarantee they will resist reforms that threaten prices. This is the no good options zone, where every lever worsens something critical. Lower interest rates inflate prices further. Higher rates crush indebted households. Restrict immigration and GDP growth craters. Expand immigration faster and infrastructure strain accelerates. Build more housing and incumbents revolt. Restrict supply and affordability collapses further. The system survives by narrowing choices until inertia becomes policy. The country does not feel poor because nothing is happening. It feels poor because everything is constrained. If this trajectory continues, Canada does not collapse. It thins. Growth persists without enrichment. Infrastructure ages faster than it is replaced. Younger workers adapt by delaying families leaving or permanently leveraging themselves to stay. Older cohorts draw down inflated wealth while services quietly ration. A homeowner in suburban Toronto, age 62, refinanced in 2024 to access equity for retirement income. The house was purchased in 1998 for $240,000. It appraised at $1.3 million. On paper, the household became wealthy. The owner did not build anything. The neighborhood did not improve. The property generated no income. The appreciation came entirely from monetary policy, credit expansion, and restricted supply. That equity will fund retirement. When asked if the system was fair, the homeowner paused, then said it was just how things worked. The economy becomes polite, expensive, and increasingly extractive, not hostile enough to provoke revolt, not dynamic enough to inspire optimism. The middle compresses, not through shock, but through arithmetic. The choice is not looming, it is already being made. Every year that asset values substitute for productivity, the future is pulled forward to fund the present. The country looks rich because it is selling tomorrow cheaply. And at some point, so people stop asking why things feel harder and start planning their lives as if this is simply what Canada is now.